This week, we're talking about cash, fraud, and internal controls. And so we've talked a little bit about this already. We've been hinting at it the last few weeks, but now we're going to go a little bit more in depth. And this is an area that is super important for businesses to think about, for owners and managers to consider, but sometimes they have a hard time thinking about this, and the consequences of it can be disastrous. And when you have a breakdown of internal controls within an organization. So we'll talk about that, and I'll give you a couple of examples of why this is an area that is so important. Okay, so an internal control system. Managers or owners of small businesses often control the entire operation. They know whether the business is actually receiving the assets and services paid for. Most companies can't maintain personal supervision and have to rely on internal controls. And so, like, for example, the business that my mom and I have, obviously we see the merchandise coming in. We actually are collecting the payments ourselves. We're handling the deposits, paying for our merchandise and paying ourselves. Very simple, very small, very straightforward. But if you have an organization, let's say, for example, like Merced College, there's no way for them to do that. And so they have to have procedures in place to make sure that, for example, that if we order supplies, that they're actually received, and that we're only paying for those items that we've received and that we've received in a condition that are usable. And also making sure that not one person has too much discretion over something to where things would be improperly paid. In fact, there was an example of that, and he obviously no longer works for Merced College, obviously, and he's gone, but he worked in our purchasing department. And he was able to be improperly paid for supposed janitorial services at a building that the college no longer owned, because we owned a building in Los Banos that we since sold when we built the new campus there out in Los Banos. And he was billing for services that he never rendered. But he was able to do that because there was a breakdown of some internal controls. And so obviously we've realized that they had to go back through and rectify that. And obviously he no longer works for Merced College. Hopefully he went to jail, spent some jail time, but I don't know exactly what happened with him. But it's something, again, to be aware of. And obviously in a large organization, it gets a lot more challenging because you have more people and you don't have that direct oversight. So managers use an internal control system to monitor and control business activities. An internal control system is policies and procedures that are used to protect assets, ensure reliable accounting, uphold company policies, and to promote efficient operations. So we'll talk some more about those areas in a minute. Now, the Sarbanes-Oxley Act, or SOX, you've heard it, requires managers and auditors of companies whose stock is traded on an exchange, those would be called public companies, to document and to verify internal controls. And so the following are some of those requirements. And so the company must have effective internal controls. Auditors must evaluate the internal controls. Violators receive harsh penalties up to 25 years in prison with fines. And auditors' work is overseen by the Public Company Accounting Oversight Board. So any of your larger companies that you can purchase stock in, they have to abide by this. But a lot of your private organizations, as well as your public institutions, also will have audits and have things done. So for example, I know, like, when I went to school at Simpson University, we had an audit come in. In fact, that changed one of the procedures in our office. And so one of the things that I would do was that I would help my boss open up the mail, because we worked in the advancement office. We received donations from people for student scholarships and that. And one of the things is I would have to sit with her, open a mail with her. She would add up everything on the adding machine, and then I would have to sign the tape, and she would as well, just to account for that nothing that she didn't take something that, she wasn't supposed to. And obviously she wouldn't have done that. But again, an audit revealed that we weren't following a procedure. So we had to follow up on that. Obviously at Merced College, that was why the issue with what happened there, that with this gentleman at Merced College, that was one of the reasons probably why how that might have come to light, was due to financial audit. So public institutions like the college, private institutions like where I went to school, Simpson, and then you have obviously your bigger companies will go through this, but a lot of your smaller companies will too. Okay, so the Committee of Sponsoring Organizations lists 5 ingredients of internal control which add quality to accounting information. So the control environment, that would be the company's structure, ethics, and the integrity of internal control. Risk assessment, that would be identify, analyze, and managing risk factors. Control activities, policies, and procedures to reduce risk of loss, and information and communication reports to internal and external policies, and then monitoring, which is regular review on the adequacy of the internal control. So principles of internal control. Internal control varies from company to company because the nature and size of the business. Certain fundamental internal control principles apply to all companies. The principle of internal controls are to establish responsibilities, maintain adequate records, ensure asset and bond key employees, separate record keeping from custody of assets, divide responsibility for related transactions, apply technological controls, and to perform regular and independent reviews. Okay, so the first part of that is to establish responsibilities. So the responsibility is a task that is clearly established and assigned to one person. When a problem occurs in a company, when responsibility is not established, determining who is at fault is difficult. For example, if 2 sales clerks share the same cash register and cash is missing, neither clerk can be held responsible. To prevent this problem, a company can use a separate cash drawer for each clerk. And so you've noticed that, and they even have to sign into the register. So when they switch out, they have to sign into the register. So that's why that's so important, is to make sure that the tasks are clearly defined and that they can be assigned to one person, and then that you can figure out who's at fault if there's any kind of an irregularity. Maintaining adequate records. Good record keeping helps protect assets and helps managers monitor company activities. When there are detailed records of equipment, for instance, items are unlikely to be lost or stolen without detection. Similarly, transactions are less likely to be entered in wrong accounts if a chart of account is used. Pre-printed forms are also a part of good internal control. When sales slips are properly designed, employees can record information effectively with fewer errors. When sales slips are pre-numbered, each slip is the responsibility of one salesperson, preventing the salesperson from stealing cash by making a sale and destroying the sales slip, because you can tell then if they're not sequential which one's missing. Computerized point of sale systems achieve the same control goal. And so again, making sure you have records of all of your assets, that you help managers to monitor company activities, like we said, like for sales. So you have detailed records, chart of accounts, pre-printed forms, pre-numbered sales slips, or you use the computer. And so, for example, kind of going back to like what happens at Merced College, pretty much everything at Merced College has an MCID number on it. So all of our computers, all of our equipment does. And so we can then figure out then if something's missing, we can figure that out. Okay. And that's important, especially right now in COVID times, when a lot of that equipment maybe has been lent out to staff or it's been lent out to students. They're still able to track it and know where it went and have records of that. So insure assets and bond key employees. Assets should be insured against losses. and employees handling lots of cash and easily transferable assets should be bonded. An employee is bonded when a company purchases an insurance policy or a bond against theft by that employee. Bonding discourages theft because bonded employees know the bonding company will pursue reported thefts. The bonding company will come after that employee. Okay. In fact, I'll give you an example of that, but that's important. Okay. So maybe, like, for example, at Save Mart, they have the person that's the key carrier that takes all the cash out of the registers and does with all of that. That person would be bonded. Or what should have happened and probably didn't was there was an example. In fact, I wrote a paper about this for one of my master's classes. We had there was a woman that she did a lot of the accounting and stuff for a company called Central Valley Nut Processing, and she ended up stealing millions, probably about $1 million from this guy that owned the company. If he had had a bond against her, he might have been able to get some of his money back, but also the bonding company would be sure that it was pursued. I mean, it was pursued anyway, because obviously the amount of money involved, and it was a high profile case, and also who she was and who her husband was. So it was pursued, but I don't know what happened after that. The funny twist was her husband was the detective for the county sheriff's department. So that was kind of a funny twist that you wonder about, and then you wonder, well, how would he not know that money's coming into the house, or if there's things happening? It was, yeah, that's weird. But anyway, if she was bonded, he would get some of his money back, and for sure it would have been dealt with. Internal control: separate record keeping from the custody of assets. A person who controls or has access to an asset must not have access to that asset's accounting records. This principle reduces the risk of theft or waste of an asset because the person with control over it knows that another person keeps its records. Also, a record keeper who does not have access to the asset has no reason to falsify records. This means that to steal an asset and hide the theft from the records, two or more people have to collude or agree in secret to commit the fraud. And so again, kind of thinking back about my example with Simpson and my boss, and how when we opened up the mail that had checks that had donations, sometimes her and I would both do that. We'd open them up, and then we'd take out, and then she'd add them up, and then I'd have to sign the tape. Well, guess what? All of that money and that tape went to another office where it was actually processed, posted into the actual account for the advancement office, the foundation, and then obviously deposited into the bank. She wasn't the one, Vonnie wasn't the one that did it, someone else did it. Okay, and so that separates that record keeping from the assets. So she had no reason to lie in that, and obviously too, both of us signing that tape and everything adding up, that proved how much money was there. And then someone else in another office then had to record it, actually record it in the computer for accounting purposes, and then had to handle the actual deposit. Dividing responsibilities, and it kind of goes along with that, what I just stated. So divide responsibility for related transactions. Responsibility for a transaction should be divided between two or more individuals or departments. This ensures the work of one person acts as a check on the other to prevent fraud and errors. This principle, called separation of duties, does not mean duplication of work. For example, when a company orders inventory, the task should be split among several employees. One employee enters a request to purchase inventory. Second employee approves the request. Third employee makes the payment. Fourth employee records the transaction. This kind of goes back to the example of what I said earlier about Merced College and the gentleman that had billed the college for and got paid for services on a building in Los Banos that the college no longer owned and no longer would have cared to have janitorial services done there. And it was fraudulent. I don't think the guy even had a janitorial business. I think he just made that up so he'd get money. So there was obviously a breakdown there in who entered it, and the same person entered it could approve it. Nobody in finance then looked at it, etc. So that's why you have to divide up that responsibility, because then there's multiple people in that chain then, because hopefully somebody, if it was something weird like that, hopefully someone along the line would question it. Okay, applying technology controls. Cash registers, time clocks, and ID scanners are examples of devices that can improve internal controls. A cash register with a locked-in tape or electronic file makes a record of each cash sale. A time clock records the exact time an employee both arrives and departs from the job, and ID scanners limit access to authorized individuals. So a lot of companies, obviously, like in a retail environment, you'll use, the cash register, and that file and everything stored there in terms of the transactions. So that way there's a record of it, of what happened, and then go back. Same thing with the time clock or the ID scanners limit access. And so you'll notice a lot of places even will have that, where like a lot of doors, you either have to punch in a code or you have to swipe a badge. And so that limits access to authorized individuals. Internal control perform regular and independent reviews. Regular reviews of internal controls help ensure that procedures are followed. These reviews are preferably done by auditors that are not involved in the activities. Auditors evaluate the effectiveness and efficiency of internal controls. Many companies pay for audits by independent auditors, and sometimes that's a requirement. These auditors test the company's financial records and evaluate the effectiveness of internal controls. And again, that's what we talked about earlier. You'll have an audit done. It's a requirement if it's a publicly traded firm, meaning that you can purchase stock in it. It's a public company. It's a legal requirement. But a lot, and it's also, for example, for any kind of a governmental organization, it's a legal requirement that it has to be done. But a lot of your private companies, like your mom and pop, or like I mentioned, Simpson University was a private university, they will pay and have this done because they want to show, good faith, and also to make sure that they are doing the right thing. So technology, fraud, and internal controls. The principles of internal control are relevant no matter what the technological state of the financial system, from manual to fully automated. Technology allows us quicker access to information. Technology improves managers' ability to monitor and to control business activities. This section describes technological impacts we must be alert to. So reduce processing errors. Technology reduces but does not eliminate all errors in processing information. Provided the software and data entry are correct, the risk of mechanical or mathematical errors is nearly eliminated. Less human involvement can cause data entry errors to go undiscovered. Errors in software can produce consistent but inaccurate processing of transactions. So you have to make sure that the code in that software, or that the configuration of that software, is correct in order to make sure that it is actually doing what is expected. More extensive testing of records. When accounting records are kept manually, only small samples of data are usually checked for accuracy. When data are accessed with technology, large samples or even the entire database can be quickly tested. New evidence of processing. Technology makes it possible to record additional transaction details not possible with manual systems. A system can record who made the entry, the time and date, the source of the entry, and so on. This means that internal control depends more on the design and operation of the information system and less on the analysis of the resulting documents, because we're able to control a lot more that can save a lot more that way. And then separation of duties. A company with a few employees risks losing its separation of duties. For instance, the person who designs the information system should not operate it. The company must also separate control over programs and files from the activities related to cash deposits and payments. For example, computer operators should not control check writing activities. So you have separate people handling that. And then increased e-commerce. Amazon and eBay are examples of successful e-commerce companies. All transactions in e-commerce involve at least 3 risks. Credit card number theft, 1. 2 would be computer viruses, and 3 would be impersonation or identity theft. Companies using technological internal controls to combat these risks. And so you have to be very careful about that, because even though you used a computer, there's still a lot of risks that can come with that. Say you have credit card number theft because of the hacking that can happen, computer viruses, and then ransomware, which is a type of virus. That's something you have to be aware of, and an impersonation or identity theft. So somebody else using someone else's card, or even what could happen, I read a thing on the Facebook, what could happen was somebody was on selling on eBay, they sold an item, and then somebody tried to message them to get them to change the address of where the item should be sent. That was not the purchaser. So you have to be smart. You have to be aware of a lot of these things and think about it. Now, limitations of internal control. Internal controls have limitations from the human element and cost benefit principle. The human element limitations can be from either human error or human fraud. And so human error is the carelessness, misjudgment, or confusion. And human fraud is the intentional defeating of internal controls, such as management override for personal gain. Human fraud is driven by the triple threat of fraud, which is the opportunity, pressure, and rationalization. Opportunity is when there's an internal control weakness in the company. Pressure could be a financial pressure, a family pressure, societal stresses to succeed. And then rationalization could include employees justifying fraudulent behavior, that it's a victimless crime, that they're not really harming the company because the company has, enough, et cetera, et cetera. The second limitation on internal control is the cost benefit principle, which says that the costs of internal controls must not exceed their benefits. Analysis of costs and benefits must consider all factors, including the impact on morale. Most companies, for instance, have a legal right to read employees' emails, yet companies rarely do unless there's evidence of potential harm to the company. Cash and cash equivalents. An effective system of internal control that protects cash and cash equivalents has to meet the following 3 guidelines. Handling cash is separate from the record keeping of cash. Cash receipts are promptly deposited in the bank, or that means that the money itself is deposited promptly into the bank. And cash payments are made by check and electronic funds transfer, or EFT. Liquidity refers to the company's ability to pay for its current liabilities. Cash and similar assets are called liquid assets because they can be readily used to pay for liabilities. A company needs liquid assets in order to operate effectively. Now, cash is what we're familiar with. That includes both paper currency cash, coins, and the deposits in a bank account. Now, cash also includes items that can be deposited into these accounts, like customers' checks, cashier's checks, certified checks, and money orders. Okay, so anything dealing with that. Now, cash equivalents then are short-term, highly liquid investment assets that meet 2 criteria. They're either readily convertible to a known cash amount and close enough to their due date so that their market value will not greatly change. Only investments within 3 months of their due date usually meet these criteria. Cash equivalents are short-term investments such as U.S. Treasury bills. Cash management. So common reason companies fail is the inability to manage cash. Companies must plan both cash receipts and cash payments. The goal of cash management are to plan cash receipts to meet cash payments when due and to keep a minimum level of cash necessary for operation. The treasurer is the person that is responsible for cash management. Effective cash management involves applying the following cash management strategies. So encouraging the collection of receivables. The more quickly customers and others pay the company, the more quickly the company can use the money. Some companies offer discounts for payments received early, and we talked about that earlier. Delay payment of liabilities. The more delayed a company is in paying others, the more time it has to use the money. Companies regularly wait to pay their bills until the last possible day. Keep all necessary assets. Acquiring expensive and rarely used assets could cause cash shortages. Should we keep only necessary assets? Some companies lease warehouse space or rent equipment as needed instead of buying it. So if there's something, you're going to do a project, you're only going to need it once, you don't want to necessarily buy that if you can rent it, because that ties up money that could be used for other things. Plan expenditures. Companies must look at seasonal and business cycles to plan expenditures when money is available and invest excess cash. Excess cash earns no return and should be invested into productive assets like facilities. Excessive cash from seasonal cycles can be placed in short-term investments for interest. Over-the-counter, and actually let me read what it says and then I'll move on. So over-the-counter cash receipts. This graphic illustrates that none of the people involved can make a mistake or divert cash without a difference being revealed. So over-the-counter cash sales should be recorded on a cash register. After each sale, customers should get a receipt. Cash registers provide a permanent, locked-in record of each transaction. The register is linked with the accounting system. Less advanced registers record each transaction on a paper tape or electronic file locked inside the register. Custody over cash should be separate from record keeping. The clerk who has access to cash in a register should not have access to its records. At the end of the clerk's work period, the clerk should count the cash in the register, record the amount, and turn over the cash and a record of its amount to the company cashier. The cashier, like the clerk, has access to the cash but should not have access to the accounting records or the registered tape or file. A third employee, often a supervisor, compares the record of total registered transactions or the registered tape or file with the cash receipts reported on by the register. This record is the basis of a journal entry recording over-the-counter cash receipts. The third employee has access to records for cash but not to the actual cash. The clerk and the cashier have access to the cash but not to the accounting records. None of them can make a mistake or divert cash without that difference being revealed. Sometimes errors in making change are discovered from differences between the cash in the register and the record of the amount of cash receipts. One or more customers can be given too much or too little change. This means that at the end of the work period, the cash in the cash register might not equal the record of cash receipts. This difference is reported in the cash over and short account, also called a cash short and over, which is an income statement account recording the income effect of cash overages and cash shortages. To illustrate, if a cash register's record shows $550, but the count of cash in the register is $555, the entry to record cash sales and its overage is shown above. So you would credit cash in the amount of the cash that actually is in, that you added up, that you actually have. And then you would record sales, the 550 credit, because that's the amount of actual sales. And then you would credit the cash short and over 5 because to account for the 5 more than that was collected over what it should have been. Now, alternatively, if a cash register's record shows 625, but the count of cash in the register is 621, the entry to record cash sales and its shortages is shown. So you would debit cash in the amount of $621 because that is the amount of cash that you have, and then you would debit cash short and over $4, and then you would credit sales $625 for the amount of actual sales. This kind of goes back to the example I gave when I was working in the advancement office. So cash receipts by mail. 2 people are assigned the task of opening the mail. In this case, theft of cash receipts by mail requires collusion between those 2 employees. The person or persons opening the mail enters a list in triplicate of money received. This list contains a record of each sender's name, the amount, and an explanation of why the money is sent. The first copy is sent with the money to the cashier. A second copy is sent to the record keeper, and a third copy is kept by the clerk who opened the mail. The cashier deposits the money in the bank, and the record keeper records the amount received. This process is good internal control because the bank's record of cash deposited must agree with the records of each of the 3. If the mail person does not report all receipts correctly, customers will question their account balances. If the cashier does not deposit all receipts, the bank balance does not agree with the record keeper's cash balance. The record keeper does not have access to cash and therefore has no opportunity to steal cash. This system makes errors and fraud highly unlikely. The exception is employee collusion. So the control of cash payments is important, as most large thefts occur from payment of fictitious invoices, like the example that I gave with the guy at the college. And so one key to controlling cash payments is to require all payments to be made by check. The only exception is small payments made from petty cash. So that what helps with that is, like, if a business is paying bills, they pay all the bills by check, unless it's something really small and they would use petty cash, which we'll talk about some more later. Now, another key is to deny access to the accounting records to anyone other than the owner who has the authority to sign checks. A small business owner often signs checks and knows from personal contact that the items being paid for are actually received. This arrangement is impossible in large businesses. Instead, internal control procedures must be substituted for personal contact. Such procedures are designed to assure the check signer that the obligations recorded are properly incurred and should be paid. Cash budgets are projected cash receipts, and cash payments are summarized in a cash budget. If there is enough cash for operations, companies wish to minimize the cash they hold because of its risk of theft and its low return versus other assets. The voucher system of control. A voucher system is a set of procedures and approvals designed to control cash payments and the acceptance of cash payments for liabilities that consists of, and so this is something you would use maybe in a larger business. You would use something like this. So liabilities consist of verifying, approving, and recording liabilities for cash payments, and issuing checks for payment of verified, approved, and recorded liabilities. A reliable voucher system follows standard procedures for every transaction. This applies even when multiple purchases are made from the same supplier. A voucher system's control over cash payments begins when a company incurs an obligation that will result in payment of cash. A key factor in this system is that only authorized departments or individuals incur such obligations. The system often limits the type of obligations that a department or individual can incur. In a large retail store, for instance, only a purchase department should be authorized to incur obligations for merchandising inventory. Another key factor is that procedures for purchasing, receiving, and paying for merchandise are divided among several departments or individuals. These departments include the one requesting the purchase, the purchasing department, the receiving department, and the accounting department. To coordinate and control responsibilities for these departments, a company uses several different business documents. This slide shows how documents are accumulated in a voucher. which is an internal document or file used to accumulate information to control cash disbursements and to ensure that a transaction is properly recorded. So explain and record petty cash fund transactions. So to avoid writing checks for small amounts, a company sets up a petty cash system. Petty cash payments are small payments for items such as shipping fees, minor repairs, and low-cost supplies. To avoid the time and cost of writing checks for small amounts, a company sets up a petty cash fund to make small payments. Petty cash activities are part of an interest system, which designates advance money to establish the fund, to withdraw from the fund, and to reimburse the fund. So establishing a petty cash fund. So a petty cash fund requires estimating the amount of small payments made during a short period of time. A check is drawn for an amount slightly in excess of that estimate. The check is cashed and given to the petty cashier or petty cash custodian. The petty cashier keeps the cash safe, makes payments from the fund, and keeps records in a secure petty cash box. In this example, Z-Mart establishes a petty cash account for $75. To illustrate, assume Z-Mart establishes a petty cash fund on November the 1st and designates one of its office employees as the petty cashier. A $75 check is drawn, cashed, and the proceeds given to the petty cashier. The entry to record the setup of this petty cash fund is shown here on this slide as a debit to petty cash for $75 and a credit to cash for $75. Now, next, assume that Z-Mart's petty cashier makes several November payments from the petty cash. Each person who receives payment is required to sign a receipt. On November the 27th, after making a $46.50 cash payment for tile cleaning, only $3.70 cash remains in the fund. The petty cashier then summarizes and totals the petty cash receipts as shown on this slide. So on the November 27th, they paid for tile cleaning in the amount of $46.50. On November the 5th, they paid for merchandise inventory, transportation in the amount of $15.05. They paid on the 18th for customers' package delivered for $5, and then they paid for office supply expense on November 15th, a purchase of office supplies that they used immediately, $4.75. So they spent a total of $71.30 of the original $75. So then we're going to replenish and reimburse the petty cash fund, so the money's there then for December. So the petty cash payments report and all receipts are given to the company cashier in exchange for a $41.30 check to reimburse the fund. The petty cashier cashes the check and puts the $71.30 cash in the petty cash box. The company records this reimbursement as shown on this slide. So we debit miscellaneous expenses, $46.50. Merchandise inventory, we debit for $15.05. Delivery expense for $5. Office supplies expense for $4.75. And then we credit cash $71.30. And so that is to reimburse the petty cash. Now, if a decision is made to increase the petty cash fund, petty cash is debited in order to increase and the cash is credited to decrease. Alternatively, if a company decides to decrease the fund, cash is debited to increase and petty cash is credited to decrease. Now, cash short and over. Sometimes errors in making change are by the petty cashier, which will result in the difference between the amount of cash receipts and cash required to bring the fund back to its original balance. This difference is reported in the cash over and short account, also called cash short and over, which is an income statement account recording the income effect of cash overages and cash shortages. To illustrate, a petty cash fund had $200 and the cash payments report shows $175 in miscellaneous expenses and $15 in cash left. The entry to record the reimbursement includes a debit to miscellaneous expense of $178, a debit to cash short and over and short for $7, and a credit to cash for $185. Basic bank services. Banks often offer certain protections for your cash. For example, use of a bank account is a more secure place for your cash than a safe at the office. Signature cards are used so the bank knows whose signature is authorized for writing checks. Deposit tickets provide support for deposits to your account. Checks provide authorization for payments from your account. Electronic funds is the transfer of cash from one party to the other. Bank statements are provided so customers can reconcile their account in a timely manner and can detect any unusual or unauthorized activity. A bank account is used to deposit money for safekeeping and helps control withdrawals. Persons authorized to write checks on an account must sign a signature card, which the bank uses to verify signatures. Each bank deposit has a deposit ticket, which lists items such as currency, coins, and checks deposited along with the amounts. The bank gives a customer the receipt as proof of deposit. Exhibit 8.4 shows one type of deposit ticket. To withdraw money, a depositor can use a check, which is a document telling the bank to pay a specified amount to a designated recipient. A check involves three parties: a maker who signs the check, a payee who is the recipient, and a bank or payer on which the check is drawn. The bank provides the depositor the checks. Exhibit 8.5 shows one type of check. It has an optional remittance advice explaining the payment. The memo line is used for an explanation. So we see here that only the top portion of this is actually the check, and then we see here the remittance advice, which lists specifically what the check is for. So you'll see this usually business checks will be like that. Now, electronic funds transfer, or EFT, is the electronic transfer of cash from one party to the other. Companies are increasingly using EFT because of its convenience and low cost. Payroll, rent, utilities, insurance, and interest payments are usually done by EFT. The bank statement lists cash withdrawals by EFT with the checks and other deductions. Cash receipts by EFT are listed with deposits and other additions. Usually once a month, the bank sends a bank statement showing the account activity. Different banks use different formats for their bank statements, but all of them include the following: beginning of period account balance, checks and other debits decreasing the account during the period, deposits and other credits increasing the account during the period, and the end of period account balance. This slide shows one type of bank statement. Identify each of the following four items in this statement. So part A summarizes the changes in the account. We see that. Oops. We see that right here. So the previous balance, the total of the checks and debits, the amount of deposits and credits, and then their current balance. And then part B lists the checks and debits, so every check that they wrote, and also then every time that money was taken out. And then we see here a list of all of the deposits and credits that were made to the account. Preparing a bank reconciliation. A bank reconciliation is a report explaining any difference between the checking account balance in the depositor's account, depositor's records, and the balance on the bank statement. The balance of a checking account reported on the bank statement rarely equals the balance in the depositor's accounting records. This is usually due to information that one party has that the other does not. We must therefore prove the accuracy of both the depositor's records and those of the bank. To do this, we prepare a bank reconciliation to explain differences between the checking account balance in the depositor's records and the balance on the bank statement. So the differences could be because of deposits in transit, the deposits that you've recorded but haven't made it to the bank yet, outstanding checks that have been written but that haven't been cashed, additions for collections and for interest. So for example, if you deposited a check in your account but there was no funds for that, oftentimes you'll be charged non-sufficient funds fee. Oh, interest. That would be the next one, bank fees and NSF checks. So that's something. Additions and collections, that would be if they're doing collection activity and they receive money, they'd add that, and also they pay interest. And then also it could be errors, either on your side or on the bank side. So in preparing the bank reconciliation, it is helpful to refer to Exhibit 8.7 and steps 1 through 9. So you enter the bank statement balance in the for the cash account. That's the balance per bank. And so in this case, Video Busters had showed that the bank had a balance of $2,050. Add any unrecorded deposits and bank errors that understate the bank balance. Video Busters' $145 deposit placed in the bank's nightly depository on October 31st is not recorded on the bank statement. Subtract any outstanding checks or bank errors that overstate the bank balance. So Video Busters' comparison of canceled checks with its book showed 2 checks outstanding, check number 124 for $150 and check 126 for $200, and then compute the adjusted bank balance. And the next part is you'll enter the company's book balance of cash. That's the balance per book. And according to Video Buster, they had a book balance of $1,405. Add any unrecorded cash receipts, interest payments, and errors understating the book balance. Video Buster's bank statement shows the bank collected a note receivable for the company on October the 23rd. The note's proceeds of $485 are credited to the company's account. The bank statement also shows a credit of $8 for interest earned but not yet recorded on the books. And then you would subtract any unrecorded debit memoranda from the bank, service charges or errors overstating the book balance. Debits on Video Buster's bank account that are not recorded yet included $23 charged for check printing and an NSF check for $30. An NSF check is dated October the 16th and was in the book balance. And then you can then compute the adjusted book balance, also called the corrected reconciled. You want to then verify that the balance in both steps 4 and 8 are equal. If so, they are reconciled. A bank reconciliation often identifies unrecorded items that need recording by the company. In Video Buster's reconciliation, the adjusted balance of $1,845 is the correct balance for as of October 31st, but the company's accounting records show a 1,405 balance. We must prepare journal entries to adjust the book balance to the correct balance. Only items impacting the book balance need to be adjusted. So we see here the first entry is to record the collection of the notes receivable by the bank. So debit cash for $485 and then credit notes receivable for $485 because they're receiving the cash payment now for that. The second entry records interest earned to its account by the bank. So you credit cash, the amount of $8, and then credit the interest revenue by $8. Now, a third entry records expenses for check printing. So we miscellaneous expense 23, and then credit cash 23. That's for check printing. And then the fourth entry records the NSF check that is returned as uncollectible. A $30 check was received from T. Woods in payment of his account and then deposited. This means that the entry must reverse the effects of the original entry when the check was received. So after these four entries, the book balance of cash is adjusted to the correct amount of $1,845, which is the book balance. So then what you would do on that last one for the NSF check is you would debit accounts receivable T. Woods because he owes that, and then you would credit cash in order to reverse it. So one more. So this is our days sales uncollected. So one measure of how quickly a company can convert its accounts receivable into cash is the days sales uncollected, also called the days sales in receivables. This measure is computed by dividing the current balance of receivables by net credit sales over the year just completed and then multiplied by 365, which is the number of days in a year. Since net credit sales usually are not reported to external users, the net sales or revenue figure is commonly used in the computation as shown in this slide. We use days sales uncollected to estimate how much time is likely to pass before the current amount of accounts receivable is received in cash. It is used to determine if cash is being collected quickly enough to pay upcoming obligations. For evaluation, we must compare this estimate to that for other companies in the same industry. We also make comparisons between current and prior periods. To illustrate, we select data from the annual reports of Starbucks and Jack in the Box. Their daily sales uncollected figures are shown on this slide. So days sales uncollected for Starbucks is 14.2 days for the current year, computed as 870 divided by 22,387 times 365. This means it takes 14.2 days to collect cash from ending sale accounts receivable. This amount reflects one or more of the following factors: a company's ability to collect receivables, customer financial health, customer payment strategies, and discount terms. To further assess Starbucks, we compare it to Jack in the Box. We see that Starbucks' 14.2 days sales uncollectible is better than Jack in the Box's 16.2 days sales uncollected for the current period. Starbucks took less time to collect its receivables. The less time money is tied up in receivables, the better. And then describe use of documentation and verification to control cash payments. This appendix describes the important business documents of a voucher system of control. Department managers are usually not allowed to place orders directly with suppliers for control purposes. Instead, a department manager must inform the purchasing department of its needs by preparing and signing a purchase requisition, which lists the merchandise needed and requests that it to be purchased. A purchase order is a document the purchasing department uses to place an order with a vendor, seller, or supplier. An invoice is a summarized statement of goods prepared by the vendor listing the customer's name, items sold, sales prices, and terms of sale. An invoice is also a bill sent to the buyer from the supplier. From the vendor's point of view, it is a sales invoice. Many companies maintain a separate department to receive all merchandise and purchased assets. When each shipment arrives, this receiving department counts the goods and checks them for damage and agreement with the purchase order. It then prepares 4 or 5 copies of a receiving report, which is used within the company to notify the appropriate persons that ordered goods that have received ordered goods have been received, and to describe the quantities and condition of the goods. So invoice approval. The accounting department should have copies of the following documents in the voucher: purchase requisition, purchase order, and invoice. With the information in these documents, the accounting department can record the purchase and approve its payment. In approving an invoice for payment, it checks and compares information across all departments. To facilitate this checking and to ensure that no step is omitted, it often uses an invoice approval, also called a check authorization. Voucher. Once an invoice has been checked and approved, the voucher is complete. A complete voucher is a record summarizing the transaction. Once the voucher certifies a transaction, it authorizes recording an obligation. A voucher also contains approval for paying the obligation on an appropriate date. Typical information requested on the inside of a voucher is shown in Exhibit 6A.4. And that for the outside is shown in Exhibit 6A.5. The information is taken from the invoice and the supporting documents filed in the voucher.